Hey everyone, welcome back. My name is Serge. I'm a certified financial planner here in Richmond Hill, Ontario, Canada, and I run a practice focusing on serving financially successful families and business owners. But I do take all calls if I know I can help. And I promised I'd have a weekly uh, video, I guess, on the topics focused on Canadians who dream of living, working, retiring, studying abroad, partially or permanently. And the one question that's come up with recently that I came across in a networking event that I was at with the Spanish Chamber of Commerce in Canada are it came up from a person that is Spanish but has lived in Canada for decades and thinking now to move back to Spain. And there's the departure tax, the deemed disposition. And it's something that you might not think about or know about unless you're in a certain level or you have additional properties or things that might be liquidated when you leave. But basically, this is a very important topic that is going to affect a lot of Canadians, whether they're born in Canada or immigrants to Canada and moving back home or somewhere else, or even just born in Canada but deciding to want to go somewhere and live somewhere else in the world as a resident somewhere else. Now, if you're going to stay a resident of Canada, this is not going to apply. But anyway, before we dive in, let's just get some of the crucial disclaimers out of the way. This video is for general informational purposes only and is not a substitute for personalized professional advice. I am not a tax lawyer or an accountant. It's also important to note that this video has not been vetted or approved by the company I represent and is therefore not on my official company channel. The insights here are for educational discussions only. The information I'm sharing today is based on third-party overviews and represents a first draft overview of this complex topic and the CRA rules around it. And yes, a deeper dive video strictly following the official CRA forms and publications is coming soon. But now let's talk about the departure tax. What exactly is the Canadian departure tax or exit tax, or deemed disposition? It's a tax that may apply when you leave Canada and cease to be a tax resident. The core of it is called a deemed disposition. The CRA treats you as though you've sold certain assets at their fair market value on the day that you leave, even if you haven't actually sold them. If those assets have appreciated in value, this deemed sale triggers potential capital gains and thus the departure tax. Now, this applies to anyone who leaves Canada permanently and severs their significant residential ties to become a non-resident for tax purposes. Severing ties usually means giving up or renting out your home, having your spouse or dependents leave with you, and breaking other social ties like health insurance and club memberships. Even if you keep some ties, a tax treaty with your new country might deem you a non-resident, which is a key factor to discuss with a professional. Now, let's look at what's on the hook here. The departure tax applies to most types of property. This includes things like non-registered investment accounts, shares in private companies, crypto assets, and personal use property like jewelry or cars with a fair market value over $10,000. Now, for the good news, there are key exemptions that are not subject to the deemed disposition rules, and these include registered accounts like your RRSP, RRIF, RESP, and tax-free savings account. Also, your principal residence, and other Canadian real estate. A huge caution here, while registered accounts are exempt from this departure tax, they may still be taxable in your new country, and your Canadian real estate will still be subject to tax on any capital gains when you eventually sell it. Now, let's talk about the current tax rate on those capital gains. There has been a critical update that the previously proposed capital gains inclusion rate increase to 66.67% has been canceled, and this means that the rate remains at the current level. Only 50% of your capital gains are taxable. This is October 2025 that I'm reading this to you or talking to you about this. So when is all this tax due? Well, the standard deadline to file your departure tax return and pay the tax is April 30th of the year following your departure. The filing deadline is extended to June 15th if you or your spouse are self-employed, but payment is still due on April the 30th. You'll need to file forms like Form T1243 to report the gains and losses from the deemed disposition. You may also have to file Form T1161 if the total fair market value of your property, all the property you owned when you left, was more than $25,000. Failing to file this disclosure form can result in a penalty of up to $2,500. If you have a large tax bill but haven't sold the assets, you can elect to defer the payment, but you must provide adequate security to the CRA to cover the tax if the federal tax owing exceeds $16,500, or in Quebec, $13,777.50. And even after you leave, you still have tax obligations on Canadian sourced income. So you'll be subject to a 25% non-resident withholding tax on income like dividends and interest. If you rent out your property, 25% of the gross rent must be withheld, and selling Canadian real estate requires 25% to 35% of the sale price to be withheld. So a helpful provision: if you do return to Canada and re-establish residency, you can potentially elect to unwind the deemed disposition. This can reduce or eliminate the tax you paid when you emigrated. So the departure tax is a critical, complex step in your move. As a certified financial planner, I can tell you that for my clients with significant investment portfolios, the deemed disposition rules require deep planning. Remember, this is a general overview, so I'm going to be doing a dedicated video soon where we dive into the nuts and bolts of the official CRA forms like T1243 and T1161. So be sure to subscribe so you don't miss that deeper dive. Now, if you are an international tax accountant and I said anything that could be phrased better or requires a finer point, please add your expert comments below. The goal here is to help the community, and your expert knowledge is invaluable. Once again, this content is for general education. Do not make any financial decisions based on this particular video. Your specific tax situation is unique and complicated, so you must consult a qualified cross-border tax professional or lawyer to ensure full compliance. Thanks for watching. If this was at all helpful, please hit the like button and subscribe. Thank you very much. See you next week.